Welcome to the Salty Investors episode number 20, the big 2-0.
Woo!
How you
Got it.
feeling, Tim?
Oh,
Pumped?
hyped, mate.
Yeah, of course you would be. It's a big day. So let's get to it as we do in every show. What's your salt for this week, Tim?
I've just learned about this new term called supercore inflation. I thought I knew a fair bit about inflation, but the normal CPI, that upticked again. You think that I'll be salty about that this week. It's gone up and the market rallied. PCI, we know about that, and PCE, and core inflation. Yeah, we sort of know. Yeah, they sort of use that to filter out things you don't really use, like housing and fuel, things like that. But now they've got this one
that you don't use.
Yeah. Now we've got supercore, which is like just focusing basically on core services. So, and they reckon Powell is sort of looking at this one pretty closely, and it's at 6.4, and it's not really dying down at all. You might know services like you get a haircut or someone mow your lawn. You're up for $80 for someone to mow your lawn. So, if he's actually really looking at this, I don't know if he's just talking this up. They're talking this up that this is why they've got to hike more. But yeah, supposedly this is the new thing that everyone should be watching. It seems like they just changed their mind, and they're going to be keep hiking for some reason, and then this will be all forgotten in 12 months. What do you think?
Well, I think there is an underlying reason for it, and that is because you've had disinflation in the goods sector, and services is still where the inflation is. That's basically it. So everybody's probably groping around for some way to figure out, how to judge this, and so maybe that's what they've come up with. Supercore. I don't know. It sounds like some sort of new product or something, like a supercore computer or something. So I think that is the reality. That's where the majority of the inflation still is. So that's probably why. But yeah, they're obviously sounding more dovish. We're getting to the end towards the cycle, but as we've said, I think the question is what happens. Is the expectation still in a lot of markets is that they cut significantly by the end of the year. I mean, all that depends on, do we have a recession? I feel, I don't know how you feel. Tell me what you feel, but I feel we've hit peak soft landing, no landing in the last sort of week or so. I don't know. That's based on my own, what I'm looking at, which we'll get into in this podcast. I've got a few charts in, but
there's people talking about 50. They're going to do 50 next.
Really?
A couple of hawks in the Fed.
Oh wow.
So, but what would that do to the market if they reverse course him to 50? That would cause all sorts of panic, I think.
I don't think.
I don't think they will. There's no way they can do that. That's impossible. But
No. So I guess we'll get into that later anyway. But
so what are you salty about?
I watched I don't know why I did this because I never usually watch it. I watched Jim Chalmers, the new Australian Treasurer, giving a press conference, and I was just insulted by the stupidity of journalist questions. Oh. I'm not impressed by Chalmers either, but somebody asked him, because obviously you would have noticed the pickup in chatter about mortgage holders are in for a lot more pain. People have finally realised this is happening. We've been talking about this for 6 months, and somebody asked him, do you ring up and talk to the Reserve Bank governor before they raise interest rates? Why are you asking questions? I mean, the whole point of the RBA is that it has to be free from government influence. That's why it's independent. And Chalmers gave the right answer. He said, regardless of, because then they got on to talking about whether they should keep Phil Lowe on. He said, regardless of whether we do that, we respect the independence of the RBA, which was the right answer. But I just disgraced that. Why are you even there, journalist, if you don't know this even basic stuff like the RBA? It's important that the RBA is, because last week, remember, my assault was about Nick McKim, who wants the government to come in and overrule the RBA and take back the rate cut. which is, it's even worse than just not knowing that the RBA is supposed to be independent. But I mean, if that's if your journalistic class or half your journalistic class doesn't know this, and you've got idiot politicians like McKim saying that, then this can get, the ball rolling, and the public starts to think, yeah, why doesn't the government just come in and stop interest rate rises? Yeah. Anyway, that's my rant.
That's well, I think the journalists are sort of on the side of not knowing, but I think it's more sinister than that. They do know, but they're hoping, the government will put pressure on them to do things. Don't
you find it strange? So this is what always baffles me, and it's why it baffles me why libertarians can't get their message out during elections. Is that surely the lesson in these types of situations, or like in 2008 with pink bats or whatever, is that the government is pretty useless. Like, they can't, if we've learned anything from the last sort of 9 months, there's not much the government can do about inflation, right? I mean, the RBA is the only one that have got this blunt instrument of monetary policy. It's going to hurt mortgage holders, and it's going to hurt discretionary spending and real wages, as we've already seen. But the answer, these people think that the answer is always government, more government. Well, the government should do this, the government should do that. It's like the government has got no ideas. Why do you keep looking to the government? This baffles me.
Well, they could do. The government could do something. They could, trim the fat.
Make it worse.
Well, they could trim the fat, but they're not going to do that. That's
the complete opposite of what they're.
Yeah. They could help inflation there. They could trim the fat there, and but woo, that's not allowed, is it? We get voted.
No,
here.
Well, it's interesting watching. It's interesting watching the sort of Labor being backed into a corner because they're publicly supporting the stage 3 tax cuts, which primarily help higher income earners. Even I hate this. I hate this commentary like tax cuts help high income earners. Yeah, well, of course they do. I mean, if you have a 5% across the board tax cut and you earn 200 grand as opposed to 50, guess who's getting a bigger tax cut in dollar terms? It's not hard. It's interesting watching them because the left, who sort of supports them, of course, hates rich people keeping more of their own money. That's horrible. For some reason, they don't think it's greedy to take other people's money and give it away.
It's fair on that side. But
but keeping your own money that's really unfair. But it's interesting what's them getting backed into, because Labor knows they're not stupid enough to know that if they go back on that cut, then there's going to be a lot of pissed off people that'll change their vote. So that's funny watching that. And then they're just getting predictably squeezed everywhere because high electricity costs. They can't really do much about that. Even if you look at the futures market of electricity, they're still predicting electricity prices are more than doubling this year. So, it's not working anywhere. And all the left-wing Twitterites who are inclined to be in favor of government intervention, want the government to do something. It's like, well, they've kind of shown you they are impotent. Anyway, let's move on. I could go on about that all day. When are we starting our politics podcast? We should start one of them. The salty pollies.
We can't do anything about that. It would be even too salty, wouldn't it?
Yeah, it'd just be full on rage the whole time. There's no upside to that podcast.
No.
All right, so a little bit of economic news out of Australia this week. Unemployment, it was interesting because we saw the unemployment rate to tick up by 0.2, 3.5 to 3.7. Oh, my God, look at that, a 3.7. So I guess the scuttlebutt is, maybe the RBA will have a second think. I doubt it based on one report. I thought the more interesting chart was the chart on the monthly hours worked. That took a real dive there. I mean, that's you can see during the COVID period, it's up and down, as you would expect. It's very volatile. It started to smooth out last year. We got a bump, sort of halfway during the year, and then because I guess that was the pent up from opening up. and then that's come off that's quite a bit to come off. You know, number of hours worked, 2% doesn't sound like a lot, but it is in a series like that. It's quite a lot. But we'll see if that, you know, maybe that reverses out next month. I don't know. But yeah, it's one of the things. You know, I think we've said this before on this podcast that the RBA doesn't want to come out and say we want to put more people out of work, but I mean that is what they want. I mean, because and so they'll be happy to see this. Whether or not it changes their view on interest rates, I doubt. I'm pretty sure they're going one more time. The market thinks they're going 2 more times. I think most of the market, and some of them think 3. What do you reckon?
Well, I'm just wondering, what's this drop from? Is this more baby boomers retiring? You know, like, are they the ones doing the big hours here, or is it more the young people? It's just a bit hard to see, you know, these big cumulative type. Just I wonder what segment is this coming from. A bit concerning. Like, we're supposed to be do mega hours in Australia, and then you see that downtick. But
like I said, I mean, if you look at that chart prior to COVID, you don't have really big ups and downs. And when you do get a down, it sort of reverses pretty quickly, right? This is the biggest sort of leg down in the post-COVID era. And, you know, I'm not sitting here going, oh, look out. It's just because, like I said, next month could just bounce straight back up again. But it's just, I thought just that was the most interesting thing I pulled out of it. Moving on. So earnings season in US. Now, this is Palm Valley Capital Management. He's a small cap guy. Ran small cap funds from, I think, through the mid 90s. He sort of retired, then he's opened this Palm Valley Capital as his own. His name's Eric Cinnamon. He has a blog. He only puts out a post every once in a while, you know, whenever he feels like it. But he monitors a few hundred stocks. You know, he goes through all their earnings calls and all the rest of it. And so what he's pulled out here is a bunch of companies that are all saying their revenue's up, but their volumes are down. You know, so, and all the revenue increases, price increases. So just, you can pick anyone there. So look at CSX, revenue up 7%, 9% increase in revenue per unit, offset a 2% decline in volume. ETD, you know, net sales 200 million, partially offset by lower unit volume. So this is the story he's picking out, that a lot of companies are reporting sales up but volumes down, which is interesting because, as you know, I don't know why it is in the financial community, we don't talk about inflation-adjusted sales or inflation-adjusted earnings. We just say earnings are up 8%, and you go, yeah, well, inflation's up 8%, so you had a flat year, basically, you know.
So I think those declines in volume, that shows that margins are compressing, you know, or whatever, and people can't afford it, you know, like less people are buying these products, you know, normal supply and demand curve here working out, you know.
Maybe those margins are actually reverting to the mean as they're supposed to.
Yes.
You know. So I just thought that was interesting because it appears Australia to me looks in worse trouble than the United States, as for reasons that we've talked about before. The household debt in this country is huge. More people on all these reset mortgages, blah, blah, blah. The US looks better. They're further along in the inflation. The inflation's coming down. We seem to be still in the thick of it for the most part. As before we went on air, we talked about the fact that you've heard a lot of soft landing or no landing. You know, we're just going to sail through in the US, and this is just sort of not so fast. So take a look at this stuff.
I want to know, are these companies going to cut their prices now? You know, inflation's coming down. Surely these people, you know, I think they're sticky. You know, I think they're going to hold here. I don't think people are going to be cutting.
Well, this is the thing, Tim. I mean, the reason why, if you go back and have a look at a can of Coke or a house or whatever it is, or a car 10 years ago, and it was a lot cheaper, is because they don't come back down. Do you think so? I mean, like someone in my line of work who buying things like Coke, I mean, every year Coke puts up their prices regardless if there's inflation, right? Because they're Coke and they know you're going to buy Coke anyway. But on top of that, last year I think there were 2 price rises in Coke, and then they've got the annual one that came out at the end of January. So you've got a can of Coke that's gone from about 75, 76 cents to 90 cents. This is in Australia, obviously, in the last 12 months. That's 20% increase in a can of Coke. And do I think Coke prices are going to come back down? Absolutely not. I mean, I'm sure that there probably are, and I don't know how to pass out what will come down. But I mean, if discretionary retail gets bad enough, you're going to see some massive discounts. I mean, that goes for any retailers. I mean, if there has really been a pull forward in, say, electronics in JB Hi-Fi and Harvey Norman and that, I mean, you wait, if they get caught with a shitload of inventory, you're going to see discounts. What do you reckon?
Yeah. Well, I just picked up a washing machine for $500, a Samsung washing machine. Yeah, brand new, delivered. So, and then it just popped back up for $750. So it just depends on their supply, how much they've got in stock and when they want to move it. And so if they've brought forward too much stuff, future sales, and then they want to resupply a whole heap and they're sitting on the shelf, wow. And then we hit a downturn. Yeah. Like my mates want to buy a boat. And I'm saying, hey, just hold off a little bit. You don't really need it now. If you can hold off 6 months, those things will be cheap as chips if we actually do hit a downturn here. So.
Yeah. Yep. This is just a quick one. Insider transactions ratio, highest level since 2022. And, obviously to read this chart when insiders are selling, usually bearish signal. That doesn't look great. I mean, these things have anomalies, not necessarily indicative of anything. Just thought I'd throw it in. I came across this Kailash Capital. They had some really interesting charts. So they called it the dot. It's compared against they called it the dot fraud .com. And you can see Glamour stocks. So maybe the Glamour stocks have got a little bit further to go. This is not a precise measure. It's whatever they consider Glamour stocks. And I think the argument against this may be that a lot of the stocks that high large cap tech is much more profitable than it was in early 2000s. And so there's earnings to underpin some of that. But maybe there's more downside to come. That's just I thought it was an interesting chart. It's funny how the 2000 bubble, which seemed so massive at the time, just looks like a blip now, doesn't it? But in percentage terms, which is what's interesting here. So what they've picked out is software stocks that have greater than 10 times price to sales ratios, right? So in 2000 they fell 80%. So, I mean, I assume that what this does is it excludes unprofitable companies, right? Because to have a price sales ratio, if you don't have any sales or if you don't, I suppose it doesn't. It does include unprofitable ones. But anyway, the relationships, still there. So I think that's the problem with history, is that you got a whole generation of investors who they know about the .com bubble, but maybe they don't know the exact detail. Like the Nasdaq fell 83% top to bottom, like that's and we what did we do, peak to trough this time around 35, and this time around we were more overvalued. So as soon
as I hear someone saying price to sales, I'm like, oh no, not you again. Like, it's just I just can't handle it. Like, surely you've heard about this problem, but
it's that's why it's the same in every cycle now. Though, they're growing sales at 30%. Yeah, how's their cash flow? Do they have any? Probably not. Peak. I think. I mean, I said something like this. I've been saying something like this. That remember that the .com peaked in March of 2000 and didn't bottom till October 2022. And so this idea, this reflexive sort of anchoring to recent experience that says, we had a bear market and then we go straight back up again. It doesn't have to go like that. I mean, the S&P basically topped out in March of 2000, and then in March of 2001, it was almost back to its previous peak, and then fell 49%.
Well, that's what I got caught in COVID. I thought I had time, 6 months.
Yeah.
And I thought, oh, no, I've got to wait here a bit more, and nah.
Yeah.
But Buffett got caught as well, so I don't feel too bad.
Most people did. Yeah.
Buffett didn't get in buy, so I don't feel too bad.
But I mean, we are 16 months from the peak, that's a pretty long bear market already. I mean, the 2007, I think, when did that peak? October 2007, and bottomed out in March 2009. Arguably, you could say it bottomed out because FASB got rid of mark-to-market accounting, and the market literally bottomed the next day. But that was about, all up was what, 18 months. Yeah. But did go down a lot further. The S&P was down 55% or so. Anyway, these are interesting charts. They're not predictive. We're not predicting anything here. I just thought I'd run through a couple of them.
What's this one?
Yeah, this was good. I think this is more of a so negative earning firms. Like it's just about investing in cash flow positive, profitable companies. That's all it is.
Okay.
Yeah. That R2500, I think, is the Russell 2500.
Okay. Russell 2500. What the hell?
Yeah, I didn't know there was a Russell 2500. I thought it was Russell 2000, Russell 1000, Russell 3, but maybe I don't know if they. So it's just because, like we said, as in those boom times in 2021 or whatever, people are always they're going after these high flyers. Stock prices are shooting up. They've got no underlying earnings, and over the long term, some of them obviously do make it. They get to a point where but most of them don't. That's the point. I thought this was an interesting one. Jesse Felder threw in. He retweeted that stocks do best when unemployment is high, and it's pretty commonsensical when you think about it, because what he's actually saying is that unemployment's high when you've had a recession, things have bottomed out, with stock prices have bottomed out, so it's best. I mean, in March of 2009, the unemployment rate kept going up, I think, until about June, but it was already close to 10% unemployment in March of 2009. That was the bottom, and obviously great time to buy. S&P 666, I think it was, wasn't it?
Crazy. Yeah.
So, and we've had a sevenfold increase. Well, at the peak, we had a sevenfold increase since then. So, it's got one of those it looks counterintuitive, but it's not if you think about it for more than 5 seconds.
But have you got cash ready? That was the problem. You can't be trying to raise money now. When it's unemployment's at 7%.
I don't know if you remember what you were doing in March of 2009, but I was not ready for a rebound, because I didn't think that because FASB had they were talking about it, but FASB had stayed really tough. Like, no, we can't just change our accounting standards just so the banks can pretend they're solvent, right? Because here's the thing about that. The media reported this wrongly when they said, the banks have to mark their assets to market. That's not quite true. Most bank assets don't have to be marked to market. So they were only asking for the assets that did, which was less than half. And I got this from Jim Chanos, because he was on at the time talking about this. He said, look, most of their assets, they don't have to mark to market.
Okay.
It's only certain ones. But FASB went back on that. And this was March 2009, and I wasn't prepared for that, And, when it happens, you're like, I got time.
Yep.
And then, and then a year later, you're going, shit. Where did this thing go?
That's why I need my VIX 40, I need some discipline, I'm not, I'll just get taken away by whatever the sentiment is, so, yeah.
Well, you see VIX got down to 17 the other day, and I actually was looking like I'm going on Interactive Brokers, and can I go long VIX, get some VIX puts or something? because you can't buy long dated puts on the VIX. It's only short stuff.
Okay.
It's pretty speculative. Yeah.
Sure, someone's got a product there they can sell you on that.
Yeah. Oh, you can get them. I mean, I have
Mhm.
a Pershing
Oh,
through Combank. If you want to trade international shares, you have to sign up and get a Pershing account. So you can do it that way, but they just don't offer the range of products you need. Like if you want to buy a put option on the S&P, it costs you thousands of dollars. They don't
yeah.
have mini
Mini
puts.
lots.
Yeah,
Mini lots of it. Yeah.
Right, so Domino's is picked this week. So this is I was going to ask you before so this is the US based Domino's.
Yep.
Which does not incorporate the profits of the Aussie one, or is it mine? So they don't own it. Any minority interest in the Aussie one?
I don't think so, but it could be. Right. I think because it's Australian listed. I think. I'm not sure, but maybe. Yeah. Just the Aussie one, you get franking. I think a bit. So yeah. I think that's where we'd probably go. But I just thought, just some of the things I see in their capital allocation are just wonderful. Like they're now automating all the pizza dough production in some of their warehouses in the US and spending big on infrastructure to automate a whole heap of stuff because the labor shortage. I don't think that's going to get solved overnight. And these guys are actually putting capital. But this is the problem I've got. You've got this, huge outlays. And you're going into a higher rate environment. How's this going to do? You can see dividend yield. You're getting payout ratio is only 28%.
Yeah.
And they're buying back shares as well. Like you can see, they're hooking into that as well. But for me, I don't know if I would be doing that. Like when you look at these, the price there is pretty good, price to free cash flow, 24 number there. And that's pretty much online what you should be buying it at. Look at those return on invested capitals in the 40s, and 50s. Like gross margin's a little bit low, but, the operating margin's still in the mid-teens here. You're still... And it's my thesis here is like when you go into a recession, these sit-down restaurants are going to get hammered. Like, but people will still want to have a treat occasionally, but where are they going to go? Well, Domino's is pretty much high on that list, I think.
That was my question for you. Actually, was that you're not so you and the wife and kids go out for your $100 meal. Takeaway normally. We do that once a week. We're not doing that now. But pizza's still only costing you what? I don't know, $20, $25 for 2 pizzas and a bottle of Coke and some garlic bread or something. Yeah, I just wonder how much they get hit. Have you gone back and had a look how they did in the financial crisis?
I've got bigger problems than that, as you'll get to in a minute. You're going to have a heart attack on. So that's the thesis. Yeah, and I'll go back to 09 and 08, having a quick look and see how they did. But I think they did fairly well. And Terry Smith got scared out of this. Like this is the one that, and it's just compounded heavily since then because they just kept on cutting rates forever and ever. There's never been any increase in rates. They just uptick it and then it goes back down again. So the debt has always been, been recycled, comes back into the system again. They'll be, can refinance every time, there's never been an issue with it. And now they can reinvest and they keep, this is the things I used to hate. They go put on debt and they do dividends and buybacks. Used to be the thing that I used to hate the most, or I used to rail against it. But, when interest rates are low, that's actually, I was an idiot,
Yeah. Well, it becomes a pretty easy equation then, doesn't it? I mean, if you can borrow at 1% and buy back stock, if it makes financial sense, then it's a good way to return capital to increase the equity value of the shareholders.
But you're just gambling that the rate's not going to increase. Like I thought that's a bit, risky. You don't know what's going to happen. So that it all looks pretty good, and then I go to the next slide and I put up the balance sheet, and this is where you will tell me to get lost, and like you look at
net debt.
So currently, current assets versus current liabilities, you're fine, you're dandy, you're beautiful. You're not. You got heaps of money there. they can pump heaps of free cash flow, but then you look at that net debt, you're up to 5 billion,
Mm.
and then you look at your free cash flow here at only, $500 million.
Yeah.
So I did something that someone told me a long time. Go look up the debt. What are the bonds being issued at? And S&P dom is BBB plus. So that's right on the bottom of investment grade.
It's basically
junk.
Almost junk. It's like in slow motion falling into the bin.
Yeah, and you're thinking, wow, junk. That should have took me back a little bit. I'm thinking, they don't have to pay it back till, the end of the decade. A lot of it.
Yeah.
But,
which they will probably roll anyway.
Yeah, they won't actually do anything. Yeah, they'll just roll it and keep paying buybacks and whatever. But
it's not a good trend, is it? It's not a good trend to just see that continue to go up. I mean, I suppose what it is that saying it's negative equity? Negative equity. Total equity is negative.
Yeah.
Oh, it is too. Yeah, because assets are Jesus.
Yeah, they haven't got any assets. Like it's an asset-light business. This is I like it, obviously. They don't actually own the franchises. I should have mentioned all that first. They just... Yeah, but obviously they're reinvesting in the distribution centers and all that sort of stuff. But you look, it was like 2 billion 2005, the net debt, and now you're like more than double it now. We're not that, 6 years later. And will they be able to roll this over in a couple of years' time? They've got tranches of it, obviously, in the next few years. But so they're probably fine because they've got the free cash flow to do that. But if it turns into a harder landing, and people actually don't go to restaurants at all, like my thesis falls apart here, it's not going to look good. But
what's interest cover then?
I didn't get that.
Free cash flows, so let's call it $500 million.
Mm-hmm.
Do you know what the interest cover is?
No, not off the top of my head. But I think they're fine currently. But as you can see from the current ratio, it's brilliant. They've got 800 and they've only got 600 in current liabilities, but just a huge amount of debt. So my question to you is, in the part of it, this is one of these things that I'm trying to, this is going to look really terrible. Like if interest rates hold where they are, people are going to go after this pretty hard, and we hit a recession. Some of that free cash flow disappears. This is the one you're going to have courage to go, I'm going to buy it because it's going to come out really strong. What do you think? The question
there is so there's got to be a reason why banks are willing to extend them this much debt whilst having, negative equity. There must be a reason for that. But whatever that reason is it a sort of, well, they've done well so far, so why not? Because that's not a good reason. Is it the type of reason that can just turn on a dime when people just go, wait a minute, these guys have got a shitload of debt, no equity, barely, cash, and may have difficulty rolling debt. Again, I want to talk to Howard Marks. What does he think about the BBB plus debt? Is he buying it?
I doubt he would be, because he's looking risk adjusted. You'd be thinking, wow, this is a little bit. But Terry Smith, I was just going back to him. Like he was just 5 years too early. So I don't think the brother was wrong on this one. It just, he didn't anticipate the cuts would continue and QE would, go on forever until inflation got out of hand. So, I don't know if Terry will go buy bottom tick this and go back into it. I think he's got enough good stuff. He doesn't have to do that sort of crazy stuff. So.
Yeah. Well, let's put the call out to our Legion army of watchers and let's ask them. What do you think about Domino's Pizza? Would you be taking a nibble here or not? That's that's all we've got this week, isn't it?
Yep.
Thanks to Tim for bringing a new stock as usual, and we will see you next time.